Hello and welcome to New Wave, the podcast where we dive into one big question. What's making waves in the European climate tech ecosystem this week? Joining me today are Hampus Jakobsson, general partner at Blue Dot, and Matthew Blain, principal at Voyager Ventures. And in today's episode, we'll talk about the case for so-called boring industries and why they might be the best place for climate funders and VCs to win big. Before we jump in, don't forget to subscribe on YouTube or to follow us on Spotify and Apple Podcasts. New episodes drop every Friday at 9 a.m. CET. All right, let's get into it. Hampus, you were in the news this week. I saw your face on a newspaper, which I thought was quite fun. You were talking about the boring as possible sector, as you call them, and why you think funders should address this market. Tell me more. What do you mean by boring exactly? And, why do you think people should build in these industries?
I think it's a combo of multiple things. I think that the thing is, if you look at the economy writ large, a lot of startups work with serving startups. Their goal is to kind of sell software to other startups, which is not a bad thing. That's definitely a market. But if you target the quote unquote old industries that are 100 years old, these are insanely large markets. Like if you look at anything from mining, logistics, manufacturing, all of those industries, they're insanely large industries. And they're insanely inefficient industries because some of them haven't been touched for 100 years, some haven't been touched for 50, and some haven't been touched for 20. But it's very, very rare to find a company which is extremely, extremely modern in older industries. So what I like about them is that these are industries where if you can get in, and usually go to market is the trickiest part, you can usually create huge efficiencies. So I like that a lot. And I think just generally that more founders should get into it. And I think the bottleneck is usually that if you're a 23-year-old that just leaves a cool vibe coding tool company that you worked for, like a Lovable, or if you're an OpenAI person or DeepMind or whatever, the problem is you usually don't have access. You actually don't know anything about those industries at all, because all of your work has been in a skyscraper, in a fancy room, and you don't know how a steel plant looks. And I think I would want to make sure that people move around more and figure out. So if I was a 22, was the report I asked, which was what I would do if I was 20, 25, I would just figure out a way to get into as many heavy industries as possible, to just work there for 3 months or 6 months, or whatever, to just understand how the heck does it work at a logistics warehouse, or how does the heck does it work at a HVAC, massive, cold storage, and just understand it's okay, so the food comes in, this is Walmart's food, we're storing it, and then they need to pick it up the day after. How do we make sure it's theirs? How do we move it out? They're just standing there, we're okay, so we don't, do we have an app for this? Or it's this just Bob has to remember it and put it on a clipboard. And I just seeing those efficiencies live for a couple of months is something I absolutely would do if I was in that age.
Matt, do you agree on that? Would you also want to go in the boring industries, quote unquote?
So I recognize the opportunity that Hampus is laying out. And I totally agree with the paradigm where a lot of these industries haven't seen a huge amount of innovation for a very long time, and they are very large industries. I think one of the reasons we don't see more companies in those spaces is VCs doing the math on exit multiples. And I think that is something that's very challenging to get around if you're building a company in that space. So perhaps to explain a little bit more detail, a software company selling subscriptions might get an 8x multiple on their ARR base when they get bought or when they go public. A cement company will get less than 1x. And most of the old-fashioned industrial companies get less than 1x. So that sets the bar in terms of the revenue base they need to hit dramatically higher than where you need to get to from an ARR subscription base as a software company. And on top of that, the timelines in these industries, just because they typically involve heavy CapEx, big projects, slow-moving companies, is typically much longer than software. So that's a very dangerous combination that puts off a lot of VCs. So I think my position is I see the opportunity, and there's definitely companies that have succeeded in doing it. I'll talk about those in a second. But at the same time, there are some structural reasons about how the whole financing ecosystem works and how we evaluate success and the timelines in which we operate that make it very, very hard. So perhaps to expand on that, there have been some exceptions to this. Companies like Tesla are an excellent example. Like automotive is a very unsexy space prior to Tesla, BYD, etc. Exactly the kind of industry that Hampus is alluding to. Fairly low margin, old-fashioned corporates that don't move particularly quickly. And I think one thing that I've noticed in this space is that companies trying to sell to the incumbents often really struggle from a timeline perspective. And I think Tesla's really paved the way that you almost have to threaten the incumbents of their own game to change an entire industry. And that's, again, I think what Tesla and BYD, et cetera, have done extremely well. But there are others as well with varying degrees of success. You might look at Soligen from a chemicals perspective. You might look at Electro or Segra that we're going to talk about later from a steel perspective. I think when you reflect on the differing levels of success some of those companies have had, where Tesla has done extremely well, and companies like Stegra are struggling. Electro, we'll talk about later, but certainly cement companies, plastics companies have really, really struggled. I think a big part of it is whether you're selling a product or a commodity. Tesla was able to sell a product, was able to differentiate with an excellent product, in their case, the Model S, that allowed them to position the market as something better than what everyone else can deliver. I think in the commodity space, if you're producing cement, it's very difficult to differentiate your cement against an incumbent cement. And you're fighting against those decade-long relationships between big corporates. And so I do think the kind of commodity versus product output is an interesting filter to look at in terms of comparing success of different companies attacking these boring industries, because commodities are frankly just very hard to win at in the VC game. The multiples are particularly low, the margins are particularly low, and the timelines are particularly long. The relationships are very tight, and all of those things come together to make it challenging to see a really exciting outcome in 10 years.
I totally agree. And I think that's, so far we have been able to stay away a lot from high CapEx upfront, needs science to become engineering, and outputs a commodity. Because those are, like, for me, super, super dangerous. Like, it just feels, and I think a lot of people in the climate tech world ends up loving those companies and starting those companies, which they're taking algae. They have this advanced process. They can turn algae into steel. It's just like 3 or 4 years of research is going to be just as hard as steel. And then they're going to build a massive steel plant. They just need 4 billion to build it. Then they're going to be almost on par with steel, and they're going to now compete with steel companies. That feels like, okay, you're going to output steel, which is, after it's built, it's just going to be steel. Nobody will know it's algae steel. I totally agree with you on Matt on the product versus commodities. And I think the other thing I think just to highlight is that also, as you said, in some of those companies you mentioned now, they go all the way, they fully vertically integrate, they deliver the whole experience. Like, even Soligen, they deliver the commodity. But I think that there are a lot of companies that just figure out, like, inside those industries, how do you make it more efficient? So, like, they might not have to take the CapEx of the industry. So we've seen quite a lot of companies that figure out a way to take, like, the softer part, so to say, of an existing industry, where today that company might solve it with, like, a Tableau or, like, BI software where they're trying to just overview the flows, but it's completely untailored to that case. They're really working with spreadsheets to solve the problem. And I think just understanding that industry and understanding what the problem is makes you be able to tailor your software, just selling software in that case, to that industry niche perfectly and being able to cater to them. But then, of course, there's also a question of TAM in those cases. Oh, now you build a cement optimization company, which we've all seen. The headache is that the cement industry isn't that large and it's heavily monopolized, and they're not used to licensing software. So I think at the end of the day, I think what I'm trying to say a lot of times is just like, if you don't know what to build, go out and look at the existing economy and find problems that you think are worth a lot to solve. And then the biggest problem of those is, how do you figure out that your solution that comes out has a viable go-to-market? Because otherwise, if you have to build the whole thing from scratch, like, you're essentially a financing, like, your biggest bottleneck will be financing. As you said with Stegra, Matt, it's like, if you're saying, okay, we're just going to build this, or the Northvolt, we're just going to build this massive factory, you essentially now have to raise insane amount of money to build something which is a bit commoditized. I mean, even batteries is magical. Batteries is a high premium commodity, but it is a commodity at the end of the day.
For sure. I think I would say that it is possible to thread the needle that Hampus just laid out. Like there are plenty of examples. I'm specifically thinking around logistics and manufacturing, where a whole range of startups in the last 3 years have entered those markets with optimization tools that are very much at the software layer. The TAM is big enough. There's enough logistics players. There's enough fleets, for example, for fleet management, to optimize fleets, charging of electric vehicles, etc. Companies like Flipturn in the US and Voltium in Europe. And then in manufacturing, companies that take in data from a vast range of sensors and tools on the production line, machines on the production line, and aggregate that into a usable format, which currently manufacturers are just kind of tearing their hair out because all these machines are spitting out data in different formats, which allows them to use that data for the first time in a better way to drive high productivity on the production lines. And I think in both of those spaces, you've seen large numbers of startups pop up in the last 3 or 4 years, pushing towards optimization and productivity gains there, in traditionally boring industries, but with a low CapEx, highly impactful software solution that they can expand from in many different directions after, whether that's by attacking other verticals once they've started in one. So we invest in a company called Ali that does the manufacturing use case for food and beverage, that can expand beyond food and beverage manufacturing into other verticals, whether that's cosmetics, which has a lot of the same processes of filling small containers, etc., or other types of CPG. So yeah, I think you can thread that needle, and there are opportunities to use software in these old-fashioned industries that have a large enough TAM, that have a fast enough sales cycle, that have high enough ACVs, and enough players to build a venture scale business. And you're seeing that play out in the market.
When I said this as a reporter, and what I mean is also if I were a founder, because the thing is that if you think about building a consumer company, let's say that like the three of us now said, let's build Instagram. Like Instagram was, if you think, of course, it was a very successful idea, but when you build it, it was an insanely strange idea. And what VCs love are the Twitters and the Instagrams and TikToks and whatever, where you can build the stuff that it's a toy, but that toy happens to take over the world, and then it's worth multi-billions, and you do crazy exits because it's a consumer company without any friction. You can just scale it to infinite size. The probability of you as a founder finding a new one of these companies, like a automated podcasting company that samples street sounds and auto-generates podcasts from your favorite people, maybe that's the next billion-dollar idea. But if you as a founder just don't optimize for yourself, just realizing, think, I want to make something that makes sure that I come out on the good side of this. Doing a consumer company like that is like massively throwing a dart from a very large distance. And if you hit, it's amazing. The cool thing with building in boring industries is that you're sure that you're going to come out whole almost. Because you have a customer that buys your product, that loves you, that says, I will pay you for this product. I need this product. If you optimize my data centers or my HVAC or whatever you're doing, or you're like running this logistic fleet or leasing these vehicles for me or whatever it is, like you have a paying customer. So I think that it was like essentially on the back note of that I felt if I was 20 to 30 now, I would go out and find problems that people would pay for that are in industries that would always pay independently what year it is. But you're definitely right, like Matt. I wouldn't say, oh, maybe you'd like the three of us should start a factory.
Yeah, not in my plans to start a factory, unfortunately. But so I hear two different perspectives, right? Like, because Matt, you laid out a bit of that. Okay, let's build the entire process and deliver the output versus Hampus talking more about optimizing some of the processes within those industries. If we think about the second use case, right, which is like optimizing within the industry, you both said that basically if I read between the lines, you're a bit scared as a VC of the market being too small, or at least you could see that there are a lot of companies in those industries that would build for a too small market to make it a VC backable company. How do you as a founder, I guess, or how do you as a VC look at those markets, and where do you draw the line? Where do you say, okay, that's big enough, that's too small?
To point to some classic examples: mining, steel, cement. These industries are, because they're producing commodities and because economies of scale is everything, the world is kind of consolidated to a handful of major players. Oil and gas is another one, of major players with insanely deep pockets. And they're just kind of behemoths that control the industry. But from a startup's perspective, if you only have 5 customers in the space, you run into the realities of B2B sales, which is even if you're offering a customer a huge amount of value, they will come back and say, if we're going to pay you more than 1 million ARR a year, we're actually just going to acquire you. We're not going to pay a subscription. And so that makes selling these kinds of innovations into these large consolidated industries like cement, like mining, like oil and gas, extremely challenging, just because the ACV is extremely low and the number of players is, well, the ACV might be high, but the number is not high enough to justify the tiny number of players.
Yeah, it definitely is the multiplication, right? It's the number of potential customer multiplied by the ACV, and if that ends up being 5 million, this is really tricky company. I would say that the thing that usually worries me when I meet these companies is the time it takes them to win a customer. Because like if you're doing optimization of cement, like say an area where we haven't touched at all, and we've met a lot of companies, it's extremely hard to get in. Like you're saying, oh, we're going to do recipe optimization. You meet the cement company, they have to give you the data. You have to be able to experiment on the data. You have to make sure that they actually run your experiment and give you the data back. And, cement is also kind of like a sourdough process where it's a continuous batch where it means take quite a while to figure out if you're actually helping out optimizing it. So I think that for me is that it's definitely one of those things where I meet these companies, some of them I've met and I realize, oh my God, you can win 1 customer per month. And this customer starts paying you and you can figure out land and expand within them. Then I'm extremely interested. But if I see that it's going to take you a year to win a customer, and as you said, Matt, there are 20 of them on the planet, then I feel like, I don't know if this is ever going to be a company. There is always a thing, which I think that how can you just take over more of the process? So as a founder, I wouldn't give up. I would, like my first company, we literally had 20 companies with logos like that were relevant. And then we had a supplier universe of another 30, 40 that could pay us. We ended up having 7 customers when we got acquired. And of course, it wasn't a VC exit. We got acquired for $150 million. So it wasn't an insane exit. In this case, we didn't have investors. But if we had investors, it wouldn't have been extraordinary for them. But like at the end of the day, we had 6 customers. And it took us 18 months to sign a customer. So it was a very, very slow burn. So I think that a VC would have looked at us and said, hey, like it took you 10 years to build a company. It was 150 exit. Too bad, right? As a founder, it was a great company. So I think that it's one of those things to think about a bit, like what to build.
I also think, consolidated industries, you end up in a situation with services versus product. If there's only, in mining, for example, there's only 5 major companies globally. They have such market power that if you're selling them a product, they know that you have to win them as a customer. So they'll go, actually, can you make it do this, that, and the other? And that reduces the scalability of the product because you're customizing it for that one customer's needs. And the reality is those types of customers are used to buying consulting services. They typically have pots of money if you're a mining company or oil and gas company. And they're used to buying bespoke services to build exactly what they need that fit their requirements exactly. And so I think, sometimes founders can make the mistake, if they're attacking one of these industries, of forcing themselves to follow the software startup route, where they're building a standardized product and looking for a venture scale outcome, and they're going to raise money off VCs. In many cases, the better business model to follow with their amazing innovation would be tech-enabled services, where they have some core
Yes.
IP, which might help a mining company, for example, identify new deposits better, or an oil and gas company identify new deposits better, whatever it might be. And then they have a consulting wrapper around that. And instead of raising venture finance, they just get hand to mouth selling project to project to project. And they go and build a really incredible $50 million, $60 million per year consulting business. But they're not trying to build a product business, which inherently is typically, selling a single thing that doesn't meet anyone's requirements perfectly, but selling it to lots and lots of people. And because you sell it to lots and lots of people, you can sell it cheaper than them building it themselves. In these consolidated industries, they often just, want something that meets their needs perfectly, which again reduces the applicability of the classic venture-funded, product-based company, that the types of companies that Hampus and I invest in.
Guys, I'm learning the craft of VC, right? And I was always told we need to invest in fast-growing markets because that way, even if the company is not growing so fast, you still capture the market growth, and that's already de-risking a little bit your investment. Hampus, you're saying completely the opposite of the story there with your boring industries, which is like they're not going fast, they're actually fairly slow. What do I need to think about that, Hampus? How should I think about a slow market?
No, I think I think that for me, that is the go-to-market. I think that what people say a lot when they mean the fast-growing market is that if you say, we build shopping agents, like agential shopping, that's a market which is like 2 years ago didn't exist. Today is a market, in 3 years is probably going to be huge. So it's an explosive market, right? But if you take HVAC optimization, just to have this episode's case, that market it's growing, definitely, but it's not growing explosively. But the thing about it is changing explosively. So I think what I like about it is that it's a market where, because energy prices are going up so quickly, that means that market has a very strong interest to shift. So if you come into the whatever HVAC market today, the market size might not grow, but your market size of selling and optimizing these companies might be explosive. So at the end of the day, I think that I'm not looking at TAM growth. I'm looking at TAM, of course, but I'm looking at go-to-market speed. If I can't see this company taking a customer fast enough, then I'm really worried. And as Matt's saying, then build a consultancy company with a wrapper. And I mean, I've met a couple of amazing startups that started off just as Matt's example were. They had a small product core, tech core, and they did tech-enabled services around it and integrated. And when they got to 3 customers, they learned so much that now they actually could take in VC money and scale, because they figured out what to build as templates and open source and what to actually make as a product core and what to do consultancy services. But it took them 2 years and they bootstrapped all the way to do that. So I think for me, it is that I want, it's not that strange to think about if you want a VC case, the VC fund has a 10 plus a couple of years lifespan. If a VC fund is 100 million and they will end up owning 10% of the company or whatever, the company needs to be worth $1 billion. If you're a pure SaaS Blade company, you might get an insane multiple. If you're a commodities company, you will get a lower than 1x multiple. So you can just fairly simple figure out what kind of revenue do I need in 10 to 15 years and how quickly can I grow it? If it takes you a year to scale million per million, well, in 10 years, you're going to have 10 million revenue. Then you have to be an extremely strategic component for somebody to acquire you for $1 billion. I mean, a DeepMind obviously didn't have lots of revenue when they were acquired. But if you're a commodities company selling, some random commodity, as Matt said, people don't know where they came from. You really you're going to be acquired by almost purely revenue. Unless you created some miracle material that makes you be able to, mine lithium on Iceland or whatever, because then suddenly it might be a geopolitical thing. But I totally agree. I think that the question is, how quickly can you scale the company?
Just to jump in there, I think if you're in VC, you often hear these rules thrown about. And the reality is there are always exceptions, whether that's someone with a background at OpenAI, Google, Amazon. People go, it's a great background, but they might be a terrible founder. Or that we only invest in second-time founders. Well, some second-time founders will be better, some second-time founders will still be poor, and some first-time founders will be amazing. I think it's an excellent rule of thumb to invest in markets that are either very large and or growing very quickly. And interestingly, at Voyager, we had a training session with one of the most successful VCs of all time in Europe, who had done a huge analysis in terms of the performance of their portfolio over 25 years. And actually, the factor that influenced successful outcomes the most was exactly what you just described. Large and growing market ahead of, counterintuitively, some of the other factors like team. So a good team attacking a large and growing market, in that, according to that data, has a higher prospect of success versus an outstanding team attacking a smaller or not growing market. So again, I think it's a good rule of thumb to follow, but there are always exceptions. And having that mental flexibility as a VC and not seeing it as an engineering problem, which has 1 + 1 = 2, therefore invest, is crucial to early stage investing.
I have just one comment on this as well, because to put it in perspective, I think now neither of us are pure play fintech investors, but I think that my boring industries, if we talk to a fintech investor, when I listen to a fintech investor, 80-90% of what they tell them he invested in are super boring industries, but within fintech boring industries. They're like, oh, this is amazing. It's a small, medium business lending company. This is a leasing company. And I'm like, these industries have existed since Jesus was born. This is not going to change. But the thing is that there's tech that makes it easier. So I think that there are, fintech investors, the majority do. Industries has been around forever. What I'm saying is that those exist everywhere.
100%. I'm actually an angel investor in a company that's looking to revolutionize lending in agriculture. And that's a classic example.
Exactly.
A lot of people don't realize that the market size for lending in agriculture in Europe only is like 450 billion euros a year, because every farm is leveraged to the hill. And it's absolutely insane. And they're serviced by like local, small, very non-tech enabled banks. And the opportunity to revolutionize that with new software, better underwriting, etc. It's huge. I think it's just a classic example of exactly what you're saying, Hampus.
And maybe just one last question. Hampus, you were talking earlier about if your talent at OpenAI or Lovable, and then someone asks you to join a boring industry, quote unquote, startup. How do you bring great talent into these startups when the problem seems like a boring problem to solve?
I would say that's not very hard. I actually think that I find so many people that if you get traction within an industry, which is a tangible industry, you can hire such amazing engineers. Like one of our companies is a steel plant optimization company. They can hire such insane engineers. It is extraordinary. And the reason is that maybe it's every boy's dream to walk inside a steel plant, but I can tell you the people they can hire are extraordinary, because right now they're sitting inside banks and inside the Goldman Sachs or inside like different institutions or the OpenAIs, and they're just sitting there in front of computers, and it's a very comfortable job. And after 1 week, they're sitting in Texas inside a steel plant, and they see how steel is made, and they realize that they're really part of making that. It's such a crazy talent magnet for certain people who feel like finally we get to do something and not just like, fold these like internet origamis better.
Is that the way you see it as well, Matt? Like, do you see a risk in not being able to hire the right talents for these problems?
I don't, actually. I consistently see similar to Hampus. If you're a great company with an incredible founding team and crucially great momentum and traction and hopefully a great product, or soon to be great products, I think you can attract great talent for sure. I think it takes a little bit more education than being a super buzzy AI company with all of the right labels for the zeitgeist. But in terms of finding talent that's really bought into the long-term mission, it's not a challenge that we've seen the truly great companies struggle with, because a lot of people interested in working with startups are primarily just looking for what is a rocket ship that I can attach my name to at an early stage and really join the ride join the ride to $1 billion scale. And so if you start to give an indication that that's your company, then typically we see that being a very compelling proposition to new joiners, even if they're in a traditionally boring industry.
Love that. That's a great takeaway. But look, thank you so much for today, guys. It was quite insightful. I will look at boring industries a bit closer now. Thank you, guys. Hampus, Matthew, it was an insightful episode as always. So thank you for making it today, and I'll see you in the coming weeks, I guess.
Sounds great. Thanks, Hugo.